All right, good morning. It's Monday around 11 o'clock a.m. Eastern Time. I hope everyone is doing well. I'm getting over a cough that's been going around. So I think I'm on the tail end of that. NyQuil, some Mucinex definitely helped somewhat with that. But I want to title this one is the correction over and talk about, what we've seen in the macro, what we've been doing the last couple of weeks, and take any questions you'll have. I hope you've been following the Lumida ledger. We've been tracking this very closely. Probably instead of writing 20-page weekend newsletter, writing 35 pages. So we've been doing a lot of analysis. I think we've gotten it correct. I think the correction is over. Correction is over. You know, on the economic side, we saw that the non-farm payrolls number came in just fine. We saw initial claims data come in just fine. We don't see layoffs, and layoffs are the markers of recession. So we think there's a lot of anxiety that's happened over the last few months from uncertainty around tariffs. We also had some bad weather in January and February, uh, and that contributed to it. And you also had a lot of over positioning, particularly momentum and crowded trades, and that's come undone. So, but we think the worst is now behind us. And what really caused markets to lift today was an article from Bloomberg citing how Trump's tariffs are likely to be more narrow and more targeted rather than broad based. So there's still headline risk. If that article is not true, that's getting priced into markets as we speak, then obviously get more volatility. But even then, though, I think so much has been priced in around that. Tariffs were really the kind of the pin in the balloon that helped to spark the correction, and really positive news around tariffs, I believe, are enough to end it. Also, in the Lumida Ledger newsletter, which again we publish every Sunday at 11 a.m., we talk about different names that we bought, what we think will do well. I'll kind of summarize briefly here, but broadly speaking, I think anything that went down the most can go up rapidly. So that would include technology. We bought Meta and Google last week. You see Tesla rallying. I had a post a few months ago that an interesting idea would be to long Nvidia and short Tesla in that pair trade. That pair trade turned out to do like 18% or so. And last week I said, don't do that pair trade anymore because even Tesla can rally. So I would not do that. Although I'm not a big fan of Tesla stock even here, but when things are so oversold, lots of things can rally. I think animal spirits will rally as well. That means names in the IWM, unprofitable tech stocks. These things can really crank. They're cranking this morning now as we speak. Uranium linked names, I think digital assets, Bitcoin miners, all of that stuff. So it's risk on mood. I published this newsletter the week before the correction started, and it was called The Bubble in Quality. And I want to revisit that here and just share thoughts on where we are now. So I'm going to share my screen here. This is interesting. This was super timely. This is February 9th, week before the correction, but we talk about Costco's forward P was 56 times earnings. We've never seen that in history. You can see it here. Walmart was at 39 times. Nvidia was at 32. Meta's at 28. Google's at 21.3. FICO is in a bubble. And then Axon 116 times. Palantir 200 times. I mean, there were signs, right? We could call this podcast, There Were Signs. Were there not signs? You know what's really funny about it too? The markets topped out the day these 13Fs were released. So people bought that last run up and then kind of rolled over. That, and also the day Zelensky was ejected from the White House, really the same day. So yeah, geopolitical combined with over positioning. But if you look at like where these are now, do I still think they're bubbles? Yes. Do I think they can rally? Yes. You can kind of hold two opposing ideas at the same time, right? But I wouldn't necessarily buy these because, I think they're expensive. But, Costco was at 57 times. Now it's at 49 times. Walmart, let's take a look at Walmart, was at 40 times. Now 33 times, right? Nvidia was at Nvidia is looking pretty cheap, all things considered now, right? Nvidia hasn't been this cheap or was even cheaper just last week. I mean, you have to go back quite a few years to see how cheap, Nvidia got. It's up 4%, 3.7% today. But it was at 23 times forward PE. That's pretty darn cheap. So Meta, we picked up quite a bit of Meta last week as well. I think we have like a 7% position on or around there. So, remember, this business was going up 20 days in a row. And if you look at my screen here, you can see where it breached the kind of prior peak in the valuations. This was bubble territory right there. And then Meta dropped down to here. And this is a business that grew earnings 48% year over year. There's value there now. Google was significantly oversold. Take a look at this. This is Google. So Google historically would bounce around these levels at 19 times, 20 times earnings. By the way, now it's 18.8. It's still cheaper than it was back then. We have a considerable amount of Google right now. We bought at this green level, then we bought more last week. So things were cheap, things got oversold, and what went down the most is going to bounce the most, including momentum factor. Momentum factor, I do believe, is back. Animal spirits are back. You're seeing recoveries in digital assets and Bitcoin. And you're also seeing a rotation back from international back to the United States. So, I think everyone got excited about European defense stocks and China and Brazil, and all that's coming back to the United States now. Not all of that, but that's the rotation at work. I would take a look at Brazil, for example. If you look at Brazil, this is Brazil. It's it's overbought. It's pulling back, and combine that with a dollar that's strengthening, or poised to strengthen, I should say. That's not going to help emerging markets like Brazil, which are commodity exporters. So, the big picture, though, you still have high valuations. If you go back to the dot-com bubble from 2000, the bubble burst in March, and you still had a recovery rally that lasted through the summer before things rolled over again. And that recovery just took place because things were oversold, and then a little bit of good news, and then people get their hopes up, and then you get a rally. The Fed was also cutting rates. So, I think we could be in a position to rally that takes us through the summer, and then you reassess. I think that's very likely. It is kind of uncanny that the markets bottomed the very same day that you had the worst seasonality, and the markets topped exactly when they're supposed to tap from a seasonality perspective. That's kind of interesting, something to keep in mind. Really, over the last 2 to 3 years, markets have been very seasonal, and it's been a highly technical market. By that, I mean, like, technicals have mattered more than fundamentals. You can see it, right? Costco and Walmart are going, they're still bubbles, but they're supposed to bounce now, so they're bouncing, right? So that's what I mean. There's a lot of that happening. I don't like that feature longer term, by the way. I don't like that feature longer term. Now, why does that feature exist? Well, I would argue it's because of QE and trillions of dollars in stimulus. There's a boatload of traders in the market. You see that through the success and growth of Robinhood, of copycat trading, of Reddit and Wall Street Bets. I think it's transformed investing significantly. And in a word, you can call it animal spirits, which is maybe the most significant factor in the markets, right? So animal spirit stocks last year were pretty much destroyed from January through September. Then the Q4 seasonality came online. Then they became the best performing factor of the year. And that, again, started to play out this year. They started to really weaken. And now to the day, I think they are back. But I think that's it. There's just a lot of money in the system. That's what it is. So one thing I've been trying to sort out is, well, hey, how does this compare to Q4 2018? In Q4 2018, you had a 19% correction, and the trough multiple on the PE was 14 times. Right now, the PE multiple is around 20 times. So there's actually, more risk to the downside. And earnings growth was actually higher back then than now. That's the bear case. That's always been the bear case, because Q4 18 was also a Trump 1.0 trade war, although you also had these Fed adjustment hikes that took place there too. But the difference between now and then also is you have a lot more money in the system now. You have a lot more liquidity in the system, right? So I think that is a different feature that we did not have back then, right? COVID changed market dynamics, I think, in a significant way. And it's scrambling historical analyses. Even the October 22 bottom didn't happen or did not occur at typical trough valuation multiples, just like today, right? So, if you look at, I met up with a friend he's a founder that built a copycat trading app. It's explosive growth with very little marketing. That's what's happening, right? And that's what's happening on Twitter and, these Substacks and all the rest. Now, ultimately, I think that gets ironed out over time, just like it did in the dot-com era. The dot-com era was very similar. I was in college back then, but my friends were online and we had these thick chart books we'd print out from the library and all this other stuff. Real-time quotes were like 20 minutes. That's the best you could get. When I think real-time quotes rolled out, that was like a big innovation. So, but you have that kind of dynamic now, so rather than try to fight it or not fight or go with it, it's more like just appreciate what that is and what impact that might have and how do you position around that. So, like the median PE ratio for a stock I own is around 13 times. I still own Meta, Nvidia, Google though. I still want my exposure to growth, but even there, I'm taking growth at a reasonable price, right? So, and we picked up airlines last week, which is good. Look at Delta and United, for example. I'll share my screen again. So, we have a big theme that this is a boomer economy. This is a boomer economy, right? Boomers are spending. Follow the boomers. Boomers have the capital. Boomers have the spending power. You go to a restaurant, boomers are paying for lunch and dinner. United Airline up 6%. We wrote about this in our newsletter last night, by the way, yesterday. But that green line right there is where we picked up some United. But not all my entries are that great, by the way. But this was a pretty good one. So United and Delta, they're cheap, and you got earnings growth 6.3 times forward PE. If you believe the consumer is fine, which I believe, then these should do fine. In fact, I'm not a big fan of these retailers, and I don't own this one, but I will say Target hasn't been this cheap in a long time. Target is facing competition from Walmart. Walmart's gaining market share, and e-com is slowly chipping away. But if you look at Target, it's pretty cheap by historical standards. But I think a better way to play a strong consumer is actually consumer finance names. Over the summer, I shared Innova as an idea. I think it'll do fine, actually. I think it'll do fine. It's up, but I have a better idea than Innova. It's up 4% today. I think names like Opportunity Finance could do pretty well. It's up 8%. These markets are going nuts. Look at this, guys, right? It's like, it's such a fast-moving market. It's a very fast-moving market. But this business, the reason why I think it can do better is that the free cash flow divided by market cap is over 120%. So they generate free cash flow equal to its market cap in a given year. So the ROE is 40% nearly. There are a number of stocks like this, by the way. I thought that was the best one, but there are a number. I mean, Dave is kind of like that. We still own Dave. We like Dave. Dave is a fintech lender. These are all bets on the health of the consumer, and actually a bet on the strength of the lower end consumer, actually, right? So, you should only really have that view if you think there's no recession. I don't believe there's a recession. I don't see it. Where are the mass layoffs? The layoffs are happening in the government sector. And there you see Dave, right? So the layoffs are in the government sector. And any given month, there's about 2 million jobs created and destroyed. There's churn. There's a natural churn in the market, in the labor market. So why can't they be absorbed? And why wouldn't they be put into perhaps more productive uses? Yeah, I guess like the Small Business Administration, like no one's at their desk. What are they doing? What are they doing? So yeah, I don't think there's a recession, folks. I think it's just a scare, But valuations are elevated, so positioning really matters. Like you can get a nice rally that lasts a couple months, but suppose Costco gets back to all-time highs. Do you really want to hold the bag when it gets there? I wouldn't buy that, even if you think that it can go up, which I think it could. I still want to do that. I still wouldn't want to own that. But there are interesting consumer-linked ideas. Another one I like a lot, actually. I have a 3% position in this, which means a lot for me. For you, that might not seem like a lot, but it is. It's called Powell, Powell, not Jerome Powell, but it's a 13 times forward PE, 14 times trailing PE. It's a data center linked idea. But we like the transcript. We like the business model. I'll share you the transcript right now. I should call some highlights here, but I do want to own some data center ideas. So they design, develop, manufacture, sell custom engineered equipment and systems. So this is like an industrial electrical equipment linked to all these data centers, right? If you go to our AI tool here, I type in Powell. You can see that revenue growth is 24% year over year. New order growth up 36% to 269 million. They have a 1.3 billion order book, and the stock has a multiple of 13 times. I like that setup. I like the data center theme. I believe that it's still intact. The week before this newsletter, we actually did a run through of 6 or 8 different data center stocks, and just folks in the transcript, not whether we like it or not, we just said, let's look at the data in the transcript. And they were all positive, and they had backlogs, similar kind of story. So the data center story is intact. CoreWeave, I believe, will be priced this Thursday and go public this week. That should be exciting. That should also enliven Animal Spirits. I think the bankers are pricing it pretty low. The first IPO out of the gate, they want to make sure BlackRock, T. Rowe, and Wellington, which are customary IPO buyers, do well. So in the beginning, the IPO buyers get good deals, and then at the end of the cycle, the IPO buyers get bad deals because they get FOMO. So I think that's going to happen, and you probably are late cycle though when the IPO markets get going. Speaking of IPOs, we bought Jefferies last week too. I've been stalking Jefferies for a long time. Did not own it, but we got it. Jefferies has like a 14 forward PE. It's up 4.5% today. But these guys are a middle market investment bank, right? Run by Richard Handler, very capable executive. Some of you might know him from the digital assets era where he tried to get a deal done with Sam Bankman-Fried. He probably doesn't want to be remembered that way, but so I like middle market because Trump really bestens policies to expand credit and lending and enable refinancing of all this debt that's coming due in private markets and public markets, right? And public debt. So the way you do that is through banks and capital markets. So I like banks. I think banks are really interesting here too. I mean, banks seem like a no-brainer from a policy perspective. If you don't believe there's a recession, banks will do well because they have earnings growth, free cash flow, regulations loosening, the capital they've got to hold is diminishing. I think I own like half a dozen different banks. I've got a lot of banks. But in capital markets, most of those names are actually kind of expensive, right? An investment bank would be capital market. Here's Goldman. It's rallying off of this as well. I thought Jefferies was a better idea, so I didn't pick this up. But if IPOs happen, then these names will do well. But it's also cyclical, right? Like the IPO market can come and go. If you look at, there are other names out there, they're just too expensive for my taste, like NASDAQ is 40 times trailing, and then CME. These are what I call capital market ideas, right? CME, ICE is a fantastic business, getting expensive though relative to the growth. But Jeffries, I thought was kind of just right in the sweet spot. So, think about all these private equity companies that have portfolios that are going to see more M&A. They'll need a debt refinancing. Jeffries, middle markets, you're avoiding those bulge bracket players who call JP Morgan and Goldman Sachs and Bank of America. Those big banks service large multinational corporations, but that middle market is underserved. That's why I like Jeffries, because I think policy is going to help that. The IPO market will open. I think they'll do well, therefore, right? I think on the banks, though, there's still a lot to do around the banks. Banks got cheap recently. And again, here's a really interesting data point for you, by the way. Brian Moynihan, the CEO of Bank of America, said that this is a great data point. Said that consumer spending year over year is up 6%. That's a big data point. I always listen to what Brian Moynihan has to say. He always comes on Bloomberg once a quarter or CNBC, and you should create a Google alert. But if the consumer spending that they see at Bank of America is one of the biggest banks in the land. They've got a lot of Visa and MasterCard data and real-time spend information. If they're seeing year-over-year spend up 6%, there's no recession. Where is that recession? It doesn't mean that consumers aren't working two jobs. It doesn't mean that the dollar isn't tight. It doesn't mean that egg prices aren't going up. They are. Okay. Consumers taking two jobs is not the same as the consumer rolling over. The ability to access a second job is actually bullish. And delinquencies are going up, but off of low levels. We picked up Capital One, by the way. Here's an interesting one. This is a nice big bank, not big, regional, I guess, 68 billion market cap, but man, all these are just moved, right? I'll walk you through in a moment what happens after these corrections end, just so you get a sense of like timing. But like forward PE is 11.5, trailing 15. There's a lot of earnings growth that analysts expect around that. But here's the kicker for Capital One. The price to cash flow ratio is 4. Is 4 times. And cash flow really is what matters in an investment. So why is the PE ratio higher? Because there must be some deductions that they're taking, whether it's CapEx, they have an acquisition that'll flow through earnings as well, right? Provisions, probably provision build, right? Provision for expected losses. But I think there's quite a few banks. I could do a whole podcast on banks. I'm not going to do that, but I've talked about banks we like in the past, and we still like those banks. If I could buy more banks, I would. Here's one other one. Remember Flagstar Bank? I called this out. I think this is going to do pretty well. It's got more volatility though, but if you believe the CRE issues are addressed there, which that's what they reported in the last earnings call, I think that's interesting. Here's another name I picked up. This is more, I call them the speculative bucket, kind of higher risk reward. I think the lows are in, which is why I think it's an asymmetric opportunity. But I call this like a Besant trade. I'm developing this Besant trade idea, but the basic thesis behind the Besant trade is, he's got to find a way to help all these companies refinance their debt. And he's been talking about lowering the 10-year, right? So HPP is this interesting business where, they're a real estate investment trust. They've got commercial real estate in LA and San Francisco, and they've got a ton of debt, by the way. So the stock's been totally destroyed. I call this like a back from the dead trade, by the way. We only bought it recently, so we avoided all that carnage. But they're paying down their debt, which you can see here. They're paying down about 34% of their free cash flow is going to their debt payoff. And the idea is that if they can pay off their debt, if they don't have any near-term issues in meeting their debt obligations in the next year, and we don't think they do, and they can lease out that space, then I think they'll rally. So the funny thing is, it's actually a bet on Silicon Valley VCs, because what's happening is they have real estate in SF. And so these startups are getting funding from VCs betting on AI. And so now the new theme is to do what Elon did at Twitter, is like get an office. So they're leasing out the spaces. And they were priced for high vacancy before. Now they're leasing out spaces and the free cash flow is going up. They can service the debt. They're paying down the debt. Then the rest flows to the equity holders, right? So I think this name could actually, maybe it could do like 40%, but my downside maybe is 20%. Maybe it could do 60%. Actually, there's on the East Coast, you had names like Veronado. I wrote about Veronado, I want to say in May of 23. And I say, hey, you might want to consider that. It rallied pretty sharply, but this is HPP. Again, it's like a 500 million market cap. This is one that you kind of have to hold your nose, I think. But I have like a 1.5 on this. I like the idea of having 10 investments at around 1 point each, where I have an asymmetrical return versus risk profile like this, right? And I look at this, I say, hey, the lows are here. The lows are behind me, right? And it's had some time to base, and I retested there, and we bought it right here, right? Now, it doesn't mean it's not going to go back down again. I have no idea. It could, right? But I think the lows are behind us. But if you take a look at the East Coast, funny thing about commercial real estate is that East Coast players have recovered substantially. Where's the CRE crisis? This is Veronado, right? I remember writing about Veronado around here, May 23. You can find it on Twitter. Like the worst was priced in. And now Veronado is up from $12 to $40. It's like 300% return. Maybe HPP has a shot at that. Maybe it has like a 15% probability of that. So the asymmetry, I think, is to the upside. Is how I look at it, right? But another one is SLG. This is a commercial real estate provider of Class A, high quality commercial real estate. And you can see it's like had an incredible rally, $20, like 55. So the East Coast CRE names have done much, much better than the West Coast CRE names. Now, if you believe that, again, people go back to office on the West Coast, then, in LA, then that can potentially benefit, right? So another interesting one is GM. So at the Nvidia GTC conference, Jensen, oh boy, this had a gap up also. Everything's gapping up now. It's a gap up and then running too. So GM, they had a Nvidia announcement as well last week at the GTC summit, when Jensen was speaking about how he's going to help GM be one of the first OEMs to have driverless cars. Look, Nvidia is competing with Tesla. Like I don't know if people fully recognize that yet, but Nvidia is going to enable automobile companies to be EV compatible and EV relevant. Nvidia built out its own data center. They already have some, but they built out its own data center. Like, that is the answer for these legacy internal combustion engine automakers. And if you look at GM, I mean, it is. I'll show you the earnings from GM, by the way. Let me show you. So the GM stock dropped something like 7% when it reported last quarter, and it reported in the middle of this correction. So I don't think it really mattered. It got destroyed in it, but it's above those levels now. But 12% year-over-year revenue increase, net income up 15% due to the operating leverage, up 15% year-over-year. So look, if stocks on average are priced to generate 8 to 11% through the long arc of history, nominal or real, take your pick, 8 to 11%, right? And now valuations are high and earnings growth is 15%. Just base case, you can say, gee, if valuations hold, I can make 15%. But then you layer on the excessively cheap valuation. Let me show you the valuation for GM versus history. Okay, we're going to share my screen here. it's 4.5 times, and the trailing P is 8. I remember reading What Up on Wall Street by Peter Lynch, and he talks about buying GE at a bargain when it was 8 times earnings, by the way. So yeah, I think this is a pretty interesting one. I don't like the other auto manufacturers, to be clear. Just GM, more flexible operation. They donated $1 million to Trump. That was smart. Hopefully they get a good tariff deal out of this. I think as it relates to tariffs, the one area I would focus on is just Mexico. I don't think Canada is really material. Mexico matters because automobile imports come through Mexico. Well, I should say GM manufactures automobiles in Mexico, where the average annual cost of a worker is $10,000. So if you have tariffs in Mexico, that would increase automobile prices about $6,500 per unit, is what the research shows, and that would hurt consumer spending and inflation. So that's really the one to watch. Canada isn't, I don't think, really that significant as it relates to what matters and what you can substitute. And I think there are a lot of substitutions out there as well. So Eurozone we'll see, but Mexico and Canada are the largest trading partners, and Mexico is one that matters. Trump really needs Mexico, right? If you have an unstable Mexico, you're going to get more illegal immigration. You're going to get a boom in the fentanyl industry. So Trump needs a stable Mexico. And fentanyl interceptions are down substantially over the last few weeks. So things are working, right? Mexico put more troops on the border, etc. There's a lot of goodwill, apparently, between the Prime Minister of Mexico and Trump. Maybe that goodwill is just because Trump knows that he needs to do a deal with Mexico, right? He's just previewing that. I think Mexico in the next few weeks is actually going to be a very interesting market to buy, and maybe soon. I don't know. This is a tough one to call timing-wise, but it's actually been an uptrend. It's up like 12 or 14% year to date, beating the S&P. But the worst is behind it. A good way to look at a market is like, is the worst behind it or not? If the worst is behind it, if the lows are in, then your bias should be to be more bullish, right? And I think for Mexico, that's the case. For Canada, I'm not sure. For Canada, I have a lot of Canadian friends out there, but we owned CLS, remember Celestica? But I'm not so sure. I think Trump is going to try to pry open that market, let American banks compete in Canada. That could be a long, drawn-out process. Canada's going through an election. They can't even do much now until all that political clarity is resolved. And until then, Canada is kind of like a punching bag for Trump. So I'm less excited about Canada. What else? So drop in any questions you might have here. Well, this is a really cool chart. I'm going to share some charts with you. This is all from our newsletter from this weekend. And this is an interesting chart here. I like this chart. It says stock market is approaching a key crossroads. This shows the S&P, excuse me, index to 100. That's the February 19th top right there. And then you can see what happens when you have a 10% drawdown. And there are really two paths. Either there's a recession or there's no recession. In the world, there's no recession, then markets go up quite a bit. And where there is recession, markets go down. Well, you don't need to be Albert Einstein to figure that one out, right? But still, if your view is there's no recession, then that's pretty constructive. Now, what they don't do is they don't control for valuation there, right? But I think that's interesting. If you look at what's working in the markets today, I think the categories that are up the most today are the ones you should really focus on, by and large. I'll share my screen here with maybe one exception. So consumer discretionary is up. I do think that'll do well. I bought a home builder, MHO. We used to own this last year. I bought it this morning. Fingers crossed. It may or may not be the bottom for home builders. May or may not. Mortgage rates are going to go up if the 10-year treasury goes up. So that's the bear case. Retailers have been absolutely destroyed though, right? We pointed target out just a moment ago. So I think that can do well. Technology was significantly oversold. They came back to earth. So I think that this can do fine, right? It's at reasonable levels for the duration of the bull market. It's not at levels you saw in 2018, right? So it's cheap relative to recent market history. So it's not perfect, but I do think you'll see a bid there. But there are names within there that are attractive, though, as I mentioned, like Google. I'm not a huge fan of these industrials, actually. I just don't see good earning strength coming out of them in the transcripts. But there's some bargains here and there. United Rentals went up a bit. We looked at it. We didn't buy it. I'm not a big fan of these industrials, except for Powell, which I mentioned, linking to data center financials. Financials we think are quite interesting. We still like them. I think it's one of the few kind of no-brainer categories. Banks will report in second week of April, which is 3 weeks away. I would want to own financials ahead of that. Markets are already kind of bidding them up right now. And then you see these defense. So healthcare has done really well year to date. I was listening to a podcast. It was a markets podcast. And they're like, yeah, well, healthcare is working. I was like, all right, healthcare is going to stop working now. That's it. Healthcare is done. Probably. We were overweight healthcare. If you were kind of following us from Q4 and the beginning of this year, and we've been talking about healthcare quite a bit. I do think healthcare is now getting kind of to like a normal valuation. These are fantastic businesses. They add defense to the portfolio, but you're seeing them lag today. I think they will keep lagging, actually. They're up only 0.3%. That's going to happen on a risk on day. Staples, I think staples are in a void or sell. So what happened in Staples is that people crowded into Staples for safety. The problem with Staples, though, is that they're very expensive, actually. They've kind of sort of gotten cheaper recently. They're like 20 times. Yeah, but this category is facing pressure from GLP-1s, right? Like, take a look at Hershey's. I actually have a short position on Hershey's. I used to like Hershey's, don't like it anymore. But 27 times forward PE, that's too much. It's down today a little bit. But I think as markets go risk on, people will exit their positions in these defensive names. Like, these had massive rallies off the lows. And this low was February 5th, right? So February 19th, when the correction got it going, February 18th, you could see people piled into these defensive ideas. Mondelez is another one. So same thing happened, right? You can see people piled into these defensive categories, including healthcare. And if you don't think there's a recession, then you're not gonna own those categories. So, but there are good businesses within there. Within healthcare, I think there's still opportunities. You do have to sift through. I think there's still good opportunities to own longer term, though. But they'll probably just lag. So some questions coming in here. Let's see. Do you have a take on Applied Digital, APLD? No, I don't have a view on this. I don't know this name. There are 35 names we have in our data center tracker, and I think you have to pick and choose your spots well. We think Powell is interesting. Sterling is not a bad idea. It's more government linked, STRL, but kind of we like Powell, like Nvidia, Taiwan Semiconductor. Those are interesting ideas, I would say. But it's I think sticking to leaders is probably the way to go, and they have reasonable valuations too. This is an interesting one. Seagate, we own this one, STX. I wouldn't say it's like my highest conviction idea, though. Let's pull it up. But it's having a little bounce today. We picked some of this up last week, actually. The thing I would say with STX and a lot of these data center names, it's really what's been the issue behind this correction. It's called overpositioning. Like, these are known names and they're kind of well shopped. The fundamentals are fantastic. Same with Micron, but I don't own Micron. I did own it last summer. I see very smart people own Micron on Twitter. I feel bad for them because it's very predictable what's happening to Micron. Like, fundamentally, it's got a strong backlog. It's beat raise. This is Micron, right? It's reported numbers. It popped 8%, and then it gave back the gains. And it's like this kind of like I call it like a pathology. It's like this pathology in overcrowded names. And that's the issue I have with that category, like Micron. All that. And this is what happens when a bubble bursts, by the way, right? Micron had a lot of hype. This is Micron. Take a look at Micron, right? Massive parabola, right? From 60 to 150. So we are now in the hangover phase, and it peaked out in June 25th, right when Kathy Wood, right? That was June 17th. That was the day Kathy Wood bought Nvidia and topped out the semiconductor market to the day. So it's been brutal since then. So one of the things I shared previously is like, don't buy after bubbles burst. Just don't buy into a bubble after it's burst, because that happens. ASML, same thing. You know, they went to the Iris-Zone conference. We owned it in October 2023, actually. Then they went to the Iris-Zone conference in April. They were considered the best business in the world, and it was downhill from there because it became consensus and overpositioned. And you know, it's cheaper now. If you like it back at Iris-Zone, you're gonna like it even more, right? And it's basing, it's getting more interesting, right? Take a look at it. But it's just all this damage it's got to get undone. And it takes like time. So you see ASML here. It's just, it takes some time. So, you know, I think that's the issue with kind of data center theme in general. It's a very crowded category. So you can have those kinds of dynamics play out. And that might impact Seagate too. As I said, we own it. I could see it running back up to the 200-day moving average. But I don't know that it'll do much beyond that. I hope it does. The numbers are great. It's not about the fundamentals. You know, Nvidia has beat and raised every single quarter, by the way. Well, they've never had a miss, but it hasn't mattered because of that positioning, right? I think that's getting undone now. I mean, it just got kind of ridiculously cheap last week, right? But this is the thing, like I think focusing on names that are under-owned that can help, and not piling into names where the bubble's already burst. Now, usually when a bubble bursts, you get a recovery almost to the highs, often not quite, and then it rolls over. And that's what I was saying with like Costco and Walmart. I wouldn't be surprised. In fact, they're rallying now. I wouldn't be surprised they rally back up. And a lot of animal spirit stocks are doing the same. I think ultimately they'll roll over. I own some of them, by the way. I'm kind of betting on that participation, but I'm trying to find the least crazy animal spirit ones that I can find, where I think they actually have a good fundamental story behind it. You know, the numbers aren't outlandish, but you know, I think over the summer though, they could roll over as a category, these animal spirit names, right? And those overvalued bubble stocks. So, you know, I think the next few months though should be mostly good. You don't have to chase though. You know, I think you'll get opportunities for another entry. You know, the risk right now is that the tariffs are more stringent than the market expects. Or if Trump wants to talk down the market, he can do that. You know, one of the reasons why we thought, you know, the market was bottoming the last 2 weeks is when Trump, it was 2 Sundays ago, he was interviewed by Maria Bartiromo, and he said, I can't rule out a recession on Sunday. That caused the Monday gap down of 3%. That forced millions of people just sold their stock Monday, Tuesday, Wednesday, relentless selling pressure. And then the worst is in. Okay. So like for those that remember the DCG Genesis FTX crisis, when Genesis put up their doors and said, we're not going to honor any redemptions, that was the bottom for digital assets, actually. There was maybe selling for 3 days, but then that was the bottom because it can't get worse. People panic sold, right? VIX hit 27, 28, 29. So that, you know, funny thing about those events is that they actually create clarity around when a market bottom happens, as opposed to having to wait and see, because you have an event that you can focus on. You can say, well, okay, event just happened. So now people have panicked. The panic's behind us. This is a really interesting comment around gold. Let me share this comment. It means the gold has also not for gold is very hard. It's very hard to kind of get a view. I can tell you the bull case, bear case for it, but I would say this: gold became the safety trade. That's the point you're making, right? It used to be TLT. It used to be the 10-year bond. So markets are changing their character, right? It used to be the TLT. I'm sure Besson wishes it was the TLT. If you recall, in September, the TLT got down to 3.6%, or the 10-year got down to 3.6%. We're at 4.3% now. And I'm going to share my screen here. I'm going to show you the 10-year interest rate. Take a look at this. Now, what's interesting, I remember back in September, there's a lot of pressure on the Fed to cut rates. The Fed did cut. They cut 50 bips. So here was September 16th. The 10-year got to 3.6%. And we're higher, even though we had a more significant growth scare now than then. Right? A good way to think of the 10-year is it approximates the nominal growth in the economy. So, including the inflation rate, right? So, but the 10-year never got that low as it did in September, even though we had a bigger growth scare. You know, the equity markets were down 10%. We didn't see that in September. So gold has become the safety trade. That's a new dynamic to keep in mind. I don't like that, by the way, either. It's not good, because when bonds tighten, it makes stocks more attractive on the margin relative to bonds, right? It's like if the 10-year was at 3.9 or 3.7 now, that'd be significantly bullish for markets, right? One is because when you value a security, you're discounting those cash flows, you get a lower interest rate in the denominator, so businesses are worth more. You know, when the 10-year got to 3.6 at the end of September, that set up a massive bull run October through December, really November 3rd through December, right? But all that potential energy locked in those treasuries came undone. People sold the treasuries and bought risk assets. Now it's different because European bonds are competing for that capital. You know, so normally you'd go buy TLT or buy bonds and on the safety trade, but now people are buying European bonds, and they're buying European stocks now, and they're buying China stuff. So, you know, the U.S. exceptionalism narrative, that's taken some dings, and that has changed certain market dynamics, which I don't like, to be clear. I don't like that, you know. So these are things just kind of keep in the back of your mind as you're, you know, identifying how you position there. But now this is a really good point too, actually. I'm going to interview Austin Campbell. Austin, for those that know him, first off, he's an incredible individual. He's a professor at Columbia. We won't hold that against him. I was an undergrad student at Columbia, by the way, too, before they went crazy. Anyway, so he testified in front of Congress about stablecoin regulation, and he has a thesis which Besson shares, that stablecoins can help not only advance U.S. dollar hegemony, but also create liquidity and financing for U.S. government debt, like hundreds of billions of dollars. I think it's a very plausible case, actually. I don't think markets fully get that story either. So we'll interview him soon. But me and do that. Just been under the weather. But that's yeah. I mean, there's a lot happening in the treasury market. Probably do a whole separate podcast there. Maybe I'll interview a friend that I had on last year who was he runs a Regan Capital. He's a fixed income hedge fund manager. That'd be really great to get his perspective. So what else? CVS, yeah, CVS, they've had a nice run, haven't they? Let's take a look at CVS. I think I kind of like, I mean, CVS it's got momentum now. It's got momentum, right? CVS is up 56% in 3 months, right? We've been talking about CVS. Remember, no one likes CVS. The classic non-consensus, right? Let me show you something about non-consensus. So, quick answer on CVS. I think stick with it while it's working. Number one. Number two is within insurance. I think there are other businesses that are higher quality and you should upgrade to quality if you can. I think there's still good insurance businesses out there. There is still, political risk around the insurance category, especially Medicare and Medicaid. Like, will Elon be effective at cutting waste and spend around Medicare and Medicaid? What does that mean for those insurance companies? Will there be changes in regulation? What happens to pharma? I'd be skeptical on pharma as we speak to the day. I'd be bearish on pharma right now, at least for a few weeks. But hey, it's working, so stick with it. That's what I would do with CVS, my take. Not financial advice, DYOR, okay? So, but once things catch momentum, it's like, hey, just, there are other names in healthcare we're looking at, by the way. If we get some weakness, we'll probably pick up some ideas there. But what else? Yeah, this is a good question. So top 5 names. So like a good size position for me is around like 3%. 3% is actually a slight overweight. So, but I do have overweights around Meta, Google, and Nvidia. Part of that is because I'm trying to get the appropriate Mag 7 exposure, but positioning differently than the benchmark. But I have other exposures there too, though, besides those 3 that can substitute for that have tech, like a Taiwan Semiconductor, for example. So there are other things in there. But, diversification is mathematically, it is the only free lunch. And if you can find things with good risk reward trade-offs and diversify out your idiosyncratic risk, you should. Like that HPP example I showed you. If I could get 10 of those HPPs that are different ideas, but they all have that similar risk reward, I'd be very happy with that, rather than having one at a 10% position. Because that 1 at 10% position, if you kind of simulate the universe 1,000 times over, sometimes it'll work, sometimes it won't work. It's actually not even about the analysis is done. It's not about that, but there's just a legitimate risk in the economy. The economy is reflexive. Markets are reflexive. Policy can influence things in ways we can't control. It's not about analyzing it even more. It's not about that, actually. The asymmetry is there, according to my analysis. I'd want 10 of them. That's what I'd like to do. Right? Now, to do that, you have to research a lot. You have to stay on top of things a lot. You need a boatload of analytics. Let me share with you some analytics, actually. You guys, I think you'll find this super interesting. So we have 3 engineers. We're going to 4 in 2 weeks. I'm excited. And I will make this open to the public. It'll take a few months, though, because there's no concept of permissioning and users and roles and all that stuff. So we run these back tests on different strategies. And check this out. This is a very simple strategy. It's called buy the cheapest stocks in the QQQ. Okay. This is similar like the dogs of the Dow. If you remember that, dogs of the Dow is like, hey, you buy the losers from last year, own it the next year. This is not quite that, because this is buying just the cheapest stocks in the QQQ. And you can see how the strategies beat in the benchmark. The strategy is in blue, the benchmark is in green, and it's done very well. So what are the names in there? Well, by the way, there's our friend Micron in there, right? Down 8%, but Regeneron. So it's buying beaten up names. Comcast, which is a really interesting idea, actually. A lot of free cash flow and buybacks there. It's not going to run as fast coming out of a correction, but it's a solid business. CTSH, we actually bought. This is a company that provides consulting services, like around AI and other things. So that company, Accenture, Booz, all these companies got smoked during the correction because of Doge. Okay. But we bought that literally this morning, by the way, CTSH, Cognizant, right at the 200-day moving average. And let me pull it up real quick here. Boom. There it is right there. There's an entry. Like if you want to get something that's not running just quite yet, market didn't wake up to this one, right? So, so if you look at all these names, we bought Accenture this morning also. Mean reversion idea up a point. So these guys got smoked. I actually shorted Accenture for 1/3 of the leg. I should have stayed in position longer. But in any case, we think this is like the low. We think the lows are here. We think it's a demand zone. And like maybe a retest or not. I don't know. But it's not a bargain, but it's cheap relative to itself. I think like with markets where you are now, it's like there are some things where I look at, I'm like, yeah, this is a no-brainer. Like just pull the trigger and go. But other things where it's like, it's like 2/3 are good, 1/3 is not quite where you want it to be. So those are like that though. But I think you can get some mean reversion off of that. I think that's probably going to happen. So let me see, what else can I share with you? Just highlights from the newsletter. But the funny thing about this market though is that it's like we do have this. I saw somewhere this reverse Uno card concept on Twitter. I think it was from Shrub. I like that concept. It's right on the mark. It's like there's a major chord and there's a minor chord in markets, and right now the major chord is playing risk on, right? And you see, like, notice like natural gas is down. Natural gas is up when the minor chord is playing. You see that during that correction is going up. Now it's going down. So I think these are quant strategies at work, different kind of correlations at work. But you see China lagging the S&P now because U.S. exceptionalism trade is back, right? Everyone piled into Germany. Germany's down now. You see that? There's people rotating back to the United States. I hope you guys didn't go chase all those those names, right? I mean, now is the time not to do that. Now is like U.S., right? And the other part I would say is, this is a nice, interesting little tell too. I'll show you. This is the USD JPY. So what we saw last week is that this was strengthening. So this is a good proxy for demand for U.S. assets. You can see that this bottom on March 10th, equity markets in the U.S. bottomed on March 13th. It was strengthening. A strong move up today. This is very constructive. This is good, right? Yen-Mageddon unwind was this August correction right around here, right? So when this is going down, it's usually not good. When this is going up, it usually means it's demand for assets. And something I read over the weekend is that the demand for Tesla stocks has been insatiable, including from people in Asia and South Korea. So that means the bull market, the retail investor base hasn't thrown in the towel yet. That's when the game is up, when the retail investor throws in the towel. That they have not done that yet. So maybe over the summer, we'll see. As I mentioned earlier in the call, I think you're set up for a rally through the summer. Analysts have dramatically lowered their earnings expectations. On what though? The consumer is solid. So I think you'll get a lot of beats next quarter. And then we reassess in the summer. We have to just revisit where we are because valuation will be back to those levels again, right? If you don't own CoreWeave, should you buy? I don't know. It's tough. I think you have to see how it prices. I have friends that are doing that, but my instinct generally is not to buy IPOs. I don't mind doing pre-IPO stuff. Like I'm the proverbial guy that likes to sell IPOs as soon as I possibly can, right? But they are pricing it attractive. You have to see how it prices, first of all. If they price on the low end of the range, it's probably good. I would see how it trades relative to Oracle, because Oracle is a comp, EQIX is a comp, Digital Realty, DLR are comps, all of them. But I believe at least 3 out of 4 of them are more expensive than CoreWeave, for what it's worth. There's some negative headlines around Microsoft pulling back some contracts from CoreWeave. I thought that was a sucker punch, right? Microsoft did that 30 days before. Actually, I think they did it in their quiet period, right? You have a quiet period before you go public. You can't say anything. I think Microsoft actually made that news about pulling a CoreWeave contract in the quiet period. Now, why would they do that? Well, CoreWeave would be a competitor for providing cloud services. That's it. But there's some drama around it. But I think the banks, want a good IPO market because they have more stock to sell. And that's another consideration for the latter half of this year. When there's a lot of IPOs launching, then you got to start getting more and more cautious. And this is an accelerated market. There are a lot of studies out there about how the average age of a bull market. I think you can throw that all out the window. This is an accelerated market, right? You have 25% back-to-back return years. A lot of returns have been compressed forward. You see that in the higher valuation. I like looking at digital assets to get a sense of kind of marginal liquidity and risk appetite. Bitcoin hit all-time highs before the halving. That's never happened before. So markets are accelerated. So I don't think the average duration of a bull market is 5 years. I don't think any of that matters. I think it's, you have some guideposts that you can look at out there. But you probably do see growth stocks outrun value stocks the next few weeks, and then value kind of pick up near the rear. Although look, like we bought Asbury Group, ABG. Let me show you this one. This is what we've been busy. We've been busy. We bought Asbury Automotive Group. This is a clever little idea, I think, because if tariffs go into play, people can buy their foreign luxury cars from a pre-owned used car dealership. Asbury Group, ABG, right? Forward PE is 9. I had a gap up this morning as well, up 3%. But what I like about it are free cash flow to market cap is 10%. They're buying back 4% of their stock. They're buying back 6% of their debt also. So I think, what you're seeing in the consumer is more value conscious consumer. So you're going to see a shift from new to used and pre-owned. People don't want to pay those tariffs to the extent they happen. And so I think but people need to upgrade their car anyway. That's going to happen, especially the consumer strong. So there are a number of different plays like that in the public markets. We thought ABG may be the best way to go about it. Yeah, this is true. That is a comp for CoreWeave, actually. It's a interesting story. I think some Eastern Europeans or Russians came together and built like a mini CoreWeave and somehow took it public or something. I don't know. So those are some of the comps to look at. What else? So type in any questions you have. So let me share. I like this tweet. I like this post as well. I'm going to share my screen with you here. So this looks at the ratio of Chinese tech stocks using KWeb to QQQ, and you can see we're at an extreme. We were at another extreme not too long ago. That was the time to buy China. We're at the opposite end of that extreme now. So in our tool, actually, in our AI tool, we look at these different ratios. I'm going to share that with you in a moment here. So you can see these ratios here. You can see SPY versus TLT. I mentioned this earlier, right? We talked about how in August, you had a big panic around people buying TLT. Didn't quite get to that level today because market dynamics have shifted. S&P versus rest of the world. You can see S&P was significantly oversold versus rest of the world. S&P versus emerging markets. S&P was significantly oversold versus emerging markets, which includes China. So that's really saying the same thing as this chart right here. But I think tracking those ratios are important. They're good. I love the newsletter. We put a lot of work into it. I hope you guys take a look at it and enjoy it. Sometimes it's a form of therapy, a lot of data dumping on there, but we try to wrap it all together in a coherent narrative. My marketing team puts a lot into this also, just putting all the graphics together and all this stuff. But let's see what else. So I think miners can rally. I think digital assets. I mentioned this last week, actually, on the Bips and Bips podcast too, right? It's like people are so despondent. I was talking to an exchange at the DAS summit, and I said, how are your clients positioned? He said, they all have cash. I was like, oh, that's bullish. What do you do with cash? You can buy stuff with cash. You don't sell stuff. You already sold, right? So interesting ideas there. Yeah, I think there's still stuff to do in China, to be clear. It's volatile enough where you can, I think, try to avoid those local peaks. What else? Some other comments and questions that are coming in. Uber, yeah, we picked up Uber tail end of December. I think so many things are cheap now. I kind of like them more than Uber. So yeah, I'm not like the biggest fan of Uber right now. I think they were really cheap. Uber was ridiculously cheap at the end of December. Then it just repriced very, very quickly. So it's down today, not participating. This is what I mean. Like, you have an accelerated market. So that Uber move should have played out over 2 years. Remember, the average annual return in the S&P is 8% to 11% ish. Like, Uber should have been up like 8% or 12% maybe. That'll be it for the year. It did that move in like 3 weeks. What do you do, right? I hit sell. That's what I did. So I don't like that market, to be clear, because it usually means you're late cycle. And plus, this is a lot. You have to be more active. I prefer just not and just hanging on to it. But like, if you can see that it's overvalued, well, why wouldn't you sell it and then rotate to something else? But I think the other names I talked about earlier have more duration to them, like the Googles and Metas of the world, Jeffries, GM, because you don't want to pay taxes, right? So if you can plan for something you can hold for a year, that's great. What else? So let me share with you some of these other strategies that we've back tested. But this will give you a different way to think about markets, right? Like, something I always say is focus on what other people aren't focusing on. We talked about cheap stocks in QQQ. Here's cheap stocks in the S&P 500. This is also beating the benchmark, considerably. This is going back to 2019. It's crushed the benchmark, right? But what are the names? Synchrony. I don't own Synchrony, but I like that idea. I like all of its peer group. I like that whole category. This is what I talked about earlier with consumer finance. Innova's a downstream competitor. Opportunity Finance, Dave. They're all comps for this idea. But if you believe the consumer is alive and well, then that should do well. We picked up some BWA this morning, actually, off of the screen. We did some research around it, but it's a meaner version idea, I should say. But interesting strategies that are out there that you can take a look at. Let me share this with you. This is pretty cool. I love this feature. I'm going to make this public too. If you guys like this, let me know. I can prioritize it. Just send me a message. But I have this new capability. It's called Twitter News. So what we do is, Twitter News is faster than real-time news, isn't it? The Drudge Report used to be pretty good at that. Then, I don't know, they went off the rails. But what we do here is we have some technology that goes out and pulls in near time Twitter content and then organizes it so I can check what's happening by different buckets. And I can star something if I want my team to read it, or my team might star it for me. So initial claims for federal workers are coming down after the late February spike. So maybe the worst is behind us, right? So that's bullish. So how cool is this though, right? Is this cool or what? I even have a bucket called Bad Traders just to see what. No, actually, he's a good trader. I like Caleb. Actually, this got misclassified. There's a really awful trader out there that I like to look at what he's doing so I know what not to do. His name is like Shay. I mentioned him before. Anyway, so research. Yeah, click that, decent idea generation. And then on the right-hand side, the AI tool will summarize what it sees. Animal spirits, crypto. So is that cool or what? So the other thing we have here is this daily news report. So we load in the headlines from the major journal. That's important because traditional media still is relevant. Twitter, social media, you need that, check. We just saw that. The second are the major headlines. So I can click on this. I can see the front page and see what's happening. 23andMe filing for bankruptcy. Anyone wants to buy this out of bankruptcy, let me know. I think we just reposition the company. There's things you can do there. But you can see some of the headlines. Tesla stock surges as it tries to avoid 10th weekly loss. We talked about Tesla earlier. Trump's housing chief embarks on shakeup at Fannie Mae and Freddie Mac. I started this. This is a key one to watch, because what impact will this have on mortgage rates? I know Besant wants to get mortgage rates down, so that's an important one to watch. Wall Street's new money shaking up the ranks of the super wealthy. Private credit titans made their fortunes in a once obscure corner of the market, right? We used to own Apollo back in the day. Remember we talked about Apollo last year? This had a bubble, and that bubble burst too, right? It's starting to recover, actually. It's got a bid now. Interesting. But yeah, that got too pricey. I mean, Apollo and these names, they're more expensive than the banks now. So I think I'd rather own the banks. But crackdown on Nvidia chips flows under U.S. pressure. Trade minister says Washington suspects high-end semis are making it to China despite trade controls. So, there is narrative pressure on China. On Nvidia to consider. Retail investors take on hedge funds in Europe's answer to meme stock mania. Small traders have have invested in defense companies targeted by short sellers in an echo of 2021's GameStop trades we were talking about earlier, right? Like COVID has transformed investing. Retail investing transformed investing. Trading View. I have a whole section in our weekend newsletter just discussing that topic. We see that. We can see it every day. We see it. I'll show you a watch list. The watch list is called Twitter Momentum. And, as I said before, it's a double-edged sword, because if you're on the right side of it, you can do well. If you're on the wrong side of it, you can really get destroyed. But on a day like today, obviously it's going to go up quite a bit. Just give me a moment here to take a look at this. There we go. This Twitter Momentum. Take a look. So put in some of the average and median returns. Median return is 4.5%. Average return 4.5%, right? These are high beta stocks. So these were all destroyed. Look at the 3-month return, down 12%, right? Some down 44%, like Wolf, Block, 20% Upstart, 40% Tesla. But now Tesla's up 10. So these are, high beta, most overvalued. There's one or two in here that I think are actually kind of interesting. Yeah, that's Twitter Momentum. And that's Twitter and Reddit has changed investing. It's created a new factor, right? So markets are far more technical than they've been before. PayPal. Yeah, I bought PayPal last week. Actually, I wrote about it in our newsletter. We wrote about it in our newsletter, actually. You can take a look at what we said about PayPal. But I've been avoiding this one for a long time. I'm still not a big fan of payments. Like, how many payments companies are there? There are too many payments companies, right? You want to own monopolies. But having said that, let's take a look at PayPal real quick here. So I'm nervous because someone's asking about PayPal now. Maybe I shouldn't own PayPal now. No, I'm kidding. No, okay. So yeah, I think technically this is basing, it's heading on up. There's some dislocation here. The 200-day moving average is pointing up. The thing I like about PayPal is the buybacks, 9% buybacks. That's good. So there's some support for it, right? So yeah, I like PayPal. I don't know that it's like I'm ecstatic about it, but I like it. I think it'll do well. I think it could beat the S&P 500 from where it is now. So, but yeah, we do own PayPal. Yeah, the CEO is fantastic. I like the CEO a lot, actually, the PayPal CEO. That's not enough, though. That's not enough. A great jockey. on a bad horse, the horse will lose the race, right? If you're the CEO of Polaroid, as camera technology advances, it doesn't matter. So it's, it's more than, if you get a great CEO with a great trend, who's well-run business, that's different, right? What does Buffett say? Buffett says, I want to own a business that any idiot can run. That's a really good perspective. Banks are like that. Not always, not always Wall Street banks, but most, kind of plain vanilla banks, regional banks they're decently well run. So insurance companies, right? So this is funny, man. You're picking up all my names. So we picked up American Express as well. Yeah, we did. We got American Express again. Like I I'm kind of like glass half full on it, but I'm not terribly excited. It's up 2.5%. Okay, that's nice. But we believe that mass affluent consumer is just fine. American Express sold off. And we put this in a kind of high quality dislocated asset. When you get a high quality dislocated asset, when people come back in the market, they go buy this stuff. So people are going to go buy American Express. So yeah, we do own it. The thing about American Express is, if I look at the historical valuation, it is. Let me show you what it's doing right now. It's fairly priced for the current bull market, I suppose. It can run up maybe the 20 times earnings, which would be like a 20% run. Maybe around there, I'd be looking to exit it. But if you look at the history, like other banks, and it's a credit card issuer, it's been a lot cheaper. So that's the thing about American Express. Like, doesn't Capital One offer more value than American Express? I think it does. So I own Capital One, as I mentioned earlier. And are they both running up the same level today? That's kind of interesting, huh? Capital One is up 2.49%. American Express up 2.46%. Very similar. But American Express gets you quality. It's got a brand. Yeah, I think Capital One is fine too. It's just downstream consumer. Yeah, 23andMe. I think buying a shell company like this, I think there's interesting things you can do with that, like what Brad Jacobs did with QXO. I think there are interesting things you can do with that. I can't share that with you guys here, but if you want to message me offline, let me know. If you got $50 million to drop on acquiring 23andMe, right? 23andMe is going. They're filing for bankruptcy, right? This was started by Sergey Brin's wife. I used 23andMe once. Pretty cool. They're filing for bankruptcy. Maybe we can go pick this up. All right, folks, I'm going to have to call it a wrap soon here. I hope that was helpful. We covered a lot of ground. Feel free to check out the Lumida ledger as well. And by the way, I think we have a waitlist page for the Lumida AI tool. So if you go to lumidaai.com, you can get on the waitlist. So we'll have those features I shared with you earlier there. You know, join the waitlist. This is my first time I've seen this page, actually. I don't know. We could probably do a little bit better with the stock photography. Is that like Elliot? Is that Elliot Investors PM? I don't know. But anyway, stop by, take a look. Always fun, and we'll do it again. Hopefully I can get Austin Campbell on later this week. There are a few people I want to get on this show. I'll also be on Bips and Bits. That records today, releases on Wednesday. All right, folks, make it a great week. Be well now. Cheers.